And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. Today is Thursday, October 30th, 2025. We have a great show for you tonight. As always, I want to thank you very much for being here. We have some distribution showing up in the indices. We've got lots of earnings, big cap tech earnings, Google, Microsoft, Starbucks reported, Apple, Amazon, Meta, so on and so forth. So we've got a lot to cover. First, let me just discuss some overview or some housekeeping. If you don't get this show in your city, you can go to GaryK.com. You can rewind, fast forward, listen anytime on any device 24/7 for free, all available on GaryK.com. You can also email Gary, follow him on X, formerly known as Twitter, by just clicking on the button. You can ask about his money management services, or if you want his premium service, it's convictionleaders.com. He gives members updates several times a day, does multiple webcasts throughout the day, and a whole lot more. All of that is available on convictionleaders.com. All right, so for some notes from Gary right off the top of the show, he's seeing some distribution showing up in the indices. Gold is setting up to go higher. Had a little pullback, but on a weekly basis it's constructive. We are seeing wild swings post-earnings, which I'll get into in more detail later in the show. We're seeing a little pullback in the indices, some distribution showing up and a little pullback in the indices. And then we've just got a lot of earnings. Yesterday we had the Fed. Gary covered that. They leaned a little bit hawkish, meaning the market wanted to see them lean more on the side of easy money or be dovish. And instead, they said, we're not sure about a December cut. Most likely we will, but we're not 100% sure. Market wasn't too happy with that, and some of the members dissented. So, typically the market likes easy money. Anything that takes away from that is considered not so good in the short term. All right, that being said, the important thing is the reaction to the news. When you put everything, all the cards on the table, it's really important to just pause and say, okay, what does all this mean, right? So when you have earnings yesterday after the bell, Meta, Microsoft, Google, Starbucks, and dozens of other stocks reported earnings before the open today, yesterday in the morning, after the close today, Apple, Amazon, so many more, it becomes almost like a lot. I'd say overwhelming, it's a lot, right? How do you handle all of that information? Oh, by the way, I'm done with Gary's notes, so I'm moving on now to the rest of the show, which is my thoughts and my opinions. So the way that I like to do it is to simplify things. Simplify it so much that almost like a 5-year-old can understand it. Okay, we know a company has earnings. They're required to report their earnings every quarter, so that's 4 times a year. And there's a few things I look for during earnings season. Number one, what are the actual numbers? And then compare them to the same quarter the prior year. So, for example, we just finished the third quarter. We're getting third quarter earnings. It's more in the fourth quarter now, but the companies are telling us what they did last quarter. Okay, I'm going to compare that to the third quarter of 2024. So I'm comparing apples to apples. I don't want to compare, Q4 tends to be a strong quarter for retailers because holiday shopping and sales and promotions, so on and so forth. I can't compare that to Q1 for retailers, which traditionally is a very slow quarter. It's not a good comparison. So I want to take the same quarter, Q1 this year compared to Q1 last year, Q2, Q3, Q4, compared to the same respective quarters year over year, and see how the company did. Why? Because that filters out a lot of the noise, number one. Number two, it helps me zoom out and look for growth. So if the company earned $1, let's say, I'm just making this up for the sake of illustrating the point, last quarter, in the third quarter, this year they earned $2. That's 100% growth in earnings. That's impressive, right? So that's the first thing I'm looking for is the earnings. And then, of course, the sales, the revenue. What are the numbers? The top line, the earnings or bottom line. Year over year. Are there growth in revenue, growth in sales going up, sales going down, earnings going up, earnings going down? So just keep that really simple. The second thing I look for, and this applies to any stock that reports earnings, by the way, is what are the numbers compared to the analyst expectations? So if Wall Street expects the company to earn $1.50, the company earns $3. Wow. And last year they earned $1, right? That is, not only are they beating numbers year over year, tremendous growth, they're also beating analyst expectations. Another bullish sign. And then what happens? Look for guidance. So after we look at the numbers, after we look at the expectations, the next thing we're doing is guidance. Guidance going forward. They raise guidance, they lower guidance. What's happening with respect to guidance? And then what we do after that is I want to see the market's reaction. Ideally, you have a company beat earnings, beat estimates, and raise guidance. And they do it several quarters in a row. And the stock goes up. Ideal scenario. That doesn't always happen. The devil, like they say, is in the details. Lots of times you'll see something where the stock goes up and the numbers aren't that good, but guidance is up. Or something in the earnings report is bullish. Or the other way around. You can have a company beat guidance and beat earnings, beat sales estimates, beat the expectations, and then they lower their guidance. You can even have a company, and the stock goes down. You can have a company beat numbers, raise guidance, but they have some kind of write-off and the stock goes down. I've seen just about every possible combination of outcomes post-earnings that you can think of, and then some. So as we make our way through earnings season, I just want to pause, step back, and then ask myself, just objectively, what's happening here? And the most important thing I do after all of that is look at how the stock reacts to the earnings. Because that tells me what the big institutions are doing with their money. Not what they're saying on TV or in the news or in their articles or research reports. All of that stuff is fine and dandy, and that's good. It's healthy. I like to see all that stuff. But really what I want to see are, what are they doing with their money? Are they buying or are they selling? And if they're buying, that's great. If they're selling, that's good too. But I want to understand what they're doing. It's not me making a judgment, oh, this is good, this is bad. Take that out of it. I'm trying to remove the emotions as much as possible from the decision-making process. It's not 100% a lock, but it helps me just look at things objectively. In other words, what's happening right now? What are the big institutions doing with their money? Are they buying or are they selling? And usually if the stock gaps up big after reporting numbers, all things being equal, that tends to be a bullish event. Not always, but many times. Why? Because it shows you, hey, you can start a new big run higher. Now, again, not always, but many times. It's followed by more price appreciation. Same thing is true when the stock gaps down. Meta, for example, Facebook, gapped down after reporting numbers. The numbers beat, didn't beat, guidance up, guidance down, the stock gapped down. That's what matters. Google gapped up but sold off because the market was a little bit iffy today. So again, how the stock reacts to the news, for me, is the single most important variable I look at. Lots of things happen. A lot. But it's really important to just pause and say, okay, let's filter out the noise and take a breath and say, what really matters in this situation? Is it a situation where you have a lot of buyers coming in on bad news, a lot of buyers coming in on good news? And then over time, time is a very powerful tool in this business, extremely powerful. And what it is, that's really, really, really good. Time heals all wounds. Time, it resets bases. Time allows investors a chance to digest the news. And then it allows them to make sense of what's happening. And it allows them to make decisions. What does this mean for me? Just because the market had a big move up or down, again, it's not a matter of good, bad. It's a matter of how does that impact my position? Am I long? Am I short? Am I doing this? In other words, am I long the stock? Do I make money if it goes up? Am I short? Do I make money if it goes down? How does the stock react with respect to my holding? So on and so forth. But really, a really powerful tool, folks, is being able to pause and look at things rationally. The knee-jerk reaction, that emotional reaction, it's how people react to things. Up, down, this, that, boom, 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 boom. Just take a minute, pause. I've been long a stock many a time and it gaps down on earnings. It's a great company, yeah, but it's being sold heavily. And usually that means lower prices follow. Not always, but usually. And same thing, just because stock gaps up doesn't mean you have to keep going, but many times it does. Again, not always. There's no absolutes in this business that I know of. So again, helping you take control and making sense of the numbers is really a superpower in this business, because that helps you get ahead, it helps you stay calm, and it helps you make better investment decisions. That being said, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience anytime you want, 24/7. All right, so a few things here. The market closed lower today. The NASDAQ fell about 377 points, closed at 23,581. The S&P 500 fell about 68 points to 6822. And the Dow fell about 109 points to 47,522. You have a few things. After the close, we've got a lot of earnings. I spoke to you at the beginning about earnings, and for the most part, earnings are mushy-ish. Some stocks are gapping up, some are gapping down. Amazon just reported numbers. It's up over 10% or $23. It closed at $222. It's now $246 in the aftermarket. Now that could change. Aftermarket action tends to be thinner, and it's not always correlated to the next day's action. But for now, it's a good gauge on how the market or how investors are reacting to the numbers. So that's Amazon. A few minutes, I'll give you the update on Apple. They report, and others as well. But for now, we've got Amazon up in the after hours. Other stocks that reported, I believe, that are going to be up big. Let's see here. I'll just wait a few more minutes and let the data come out. So a few thoughts here. We have the ability to look at the numbers. We spoke about we're in the thick of earnings season. We want to digest the numbers. And it's really important to just pause and say, okay, how does this impact me and how does it impact my portfolio? Today, we had a lot of movers that gapped down after reporting numbers. Meta was down about 11% today. They were on earnings. A lot of other, Chipotle was down 18%. Meta ticker symbol META, Chipotle ticker symbol CMG, down about 18%. CI, Cigna, down about 17%. eBay, down about 16%. Roblox, eBay is EBAY, Sigma is CI, eBay, EBAY, down about 16%. Roblox, RBLX, down about 15.5%. Carvana, CVNA, down about 13% today. Let's see, Stella, STLA, which they make the Jeep company, they were down about 9.6%, the car maker. Shark Ninja was down 8%. Let's see here. Rocket Lab, RKLB, was down 7.7%. Reddit was down a little bit. Nothing major there. And a few other ones. Galaxy fell today. Boeing fell today. So when I look at the market in general, just zooming out, there's a lot of down movers. On the upside, it's probably about half of that. Lilly was up today. Google was up today. CHRW was up today, XPO a little bit, RGTI, but nothing really, crazy where I'm like, oh no, I need to just stomp my feet and go nuts buying. In fact, I don't ever say I need to buy it right now. It's more along the lines of, okay, I want to see what's happening in real time and then make a decision based on, the information that's in front of me, and then let time pass. I don't want to make an emotional decision. Right. So as we go through earnings, we've got hundreds of companies reporting this week, hundreds next week, and so on and so forth. Just take our time. I'm not going to catch every big move, and that's okay. That's the other side of this. I used to drive myself nuts early on saying, I've got to catch every single big stock, and I missed them. It's inevitable. It's going to happen. I now understand with age and experience. I've been doing this since the 90s that, okay, there's no way for me to catch every big stock, and that's okay. I don't need every big one. I just need to catch one or two, and I'll do very well. Team, TEAM, Atlantis, or the ticker symbol TEAM, is up nicely in the aftermarket. A few other ones, earnings are coming out now. Let's see. ILMN looks like it's up nicely in the aftermarket as well. So I'm not going to catch every big stock, and that's okay. I don't have to. And I don't know anybody that can consistently catch every big stock every single time. Again, don't have to. What do we have to do is manage risk. And it's not the greatest topic for people to talk about, but it's a superpower. It's the greatest skill I know and I've learned that the best traders and money managers understand. It's a business of risk management. Over time, the stocks change. We had a tulip bubble in Holland hundreds of years ago. We had a dot-com bubble in the 90s when I started trading, and then the bust after both those bubbles popped. We saw, AI is hot now. We've seen real estate bubbles in the past, credit bubbles. Bubbles come all different shapes and sizes. Trends in the market's trend come in all different shapes and sizes. Leading stocks come in all different shapes and sizes. I just watched a great documentary called Titans of Wall Street and Titans of Hollywood on Netflix over the last few weeks in the treadmill. And it's great stories. It tells you JP Morgan, it tells you about Paramount, how it started, and Universal, how it started, and all this fun stuff. I love to learn, and I love to watch these documentaries because it's fun, entertaining, but it's also educational as well. And these Titans of Wall Street, Merrill Lynch, how they started. Merrill was worried and bearish about the market in 1929 before the dot-com, before the roaring 20s bubble popped, right before the Depression. And he urged his clients publicly to get out. Lynch didn't want to do that, but thankfully they did that, and that's what saved the firm. So it's managing risk. It's easy to get caught up in the excitement du jour, whatever that latest headline is. This new thing is going to change the world, and in some respect it does. We're all driving cars. 100 years ago, Ford, the automobile stocks, were super strong. GM, they told you how Goldman Sachs started. And they brought Sears Roebuck public. They IPO'd Sears, right? So, and again, all these great stories. And for me, I love that stuff. But also, it's risk management. And it's our job today. One of the smartest things someone's ever told me, and I've interviewed a lot of people. I have a podcast called Smart Money Circle where I interview money managers and CEOs of publicly traded companies for timeless advice. And I love to learn. I go in there with that knowledge of, I know I don't know, so I've got one job, it's to learn. And these folks all say the same thing. Do the right thing, acts of service, help others. There's common themes. But one of the guys said, hey, Adam, you're not buying and selling a stock. I go, what am I doing? He goes, you're buying and selling risk. It's like, wow. The company's going to report earnings. They're going to report another earnings in 3 months, another earnings in the next quarter, another earnings next quarter. It's going to happen. You're going to see stocks gap up, stocks gap down. It's the risk management, folks. If you can walk away with anything, it's walk away with that superpower. Everybody pulls out the calculator when they come to the market. Oh, I'm going to get so rich if I just buy 1,000 shares of this, 10,000 shares of that. It goes up. I'll pay off my house, or do this or do that. I'll retire. What? Okay, great. They're looking at one side of the equation. But most people, sadly, dismiss the other side of the equation, which is what? Managing risk. And that, folks, is a super power. So, up next, I believe we have a lot more to cover. I'm Adam Sarhan, and this is the one and only Investor's Edge. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. All right, in case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience on any device 24/7. All right, so a few things. We spoke about earnings. Apple reported earnings. They missed expectations from what I can tell. The expectations, no, hold on a second. 185, they earned, 185. No, it says Apple reported 185 per share in the fourth quarter, ended September 2025. The consensus estimate is 173 per share. That's higher, okay. But 101, the earnings whisper number was 186. All right, so let me talk about that for a second. So there's actual consensus number, which was 173 for Apple. The earnings was 185 that came in. Then there's a whisper number, which is the unofficial number that Wall Street estimates or analysts expect the stock to do, or it's where the numbers should be from an earnings standpoint. So the actual estimate, the estimates vary. Some analysts, have $1.73, some have 175. It varies, but there's a consensus. So the consensus based on the data that I look at is 173. The stock came in at 185. But the whisper number was 186. So after hours, I have the stock down. That could change, but as of right now, the stock is down. Amazon continues to be the big mover up after the close. Netflix, I have news that they're going to report a stock split, and they're going to do, I think, a 10-for-1 stock split. So that's helping the stock. Let's see here. There's a lot of news, so I'm trying to read and make sense at the same time. So yeah, that's helping Netflix go up about 3% after hours on that news of a 10-for-1 stock split. And that was announced, 4 minutes ago? So there's that. And then Amazon's up big. It's just Amazon's the big, after hours winner so far. Lots of companies reported earnings today after the close, but it's Amazon. Let's see, WDC. That one looks like it's up as well. Let me confirm that before I go any further. It looks like, WDC, Western Digital Corp, is up about 10% as in the after hours. Twilio is up about 6% in the after hours. I believe that's on numbers as well. So again, it's going to be a mixed bag. So we've got all these companies coming out. Some of them are up after hours, some of them are lower. We've got stocks that break out, stocks that move up, move down. How do you make sense out of all of this? So I built a website called breakoutsandssetups.com. There's a free trial if you want to try it. It's only $39 a month thereafter. Cancel if you don't like it, with a 90-day money-back guarantee. But it's the lowest price I can go just to cover the cost of the data. But there, I give people breakouts and setups, also in real time, so you could see all day, every day. I don't have to guess anymore. It saves me hours and hours of just scanning the market, endlessly looking for breakouts, and then I see a stock, it's above the pivot in the morning, the afternoon it's below the pivot, and then I'd lose it and then find another. It was just too much. So it took me years to put this together, but now I've automated a lot of that work with proprietary algorithms and all this fancy schmancy stuff, but really simple. It gives people stocks that are breaking out in real time. It gives people stocks that are setting up to break out. And then it gives breakdowns. You want to see stocks, that are breaking down below support. You can see that as well. Meta was one of those stocks today that showed up. Chipotle showed up there as well. Then we have movers. We have movers up and movers down. All that's available during the day. So you can see the action by just clicking movers up. You click stocks that are gapping up. We've got gapping down. And then you've got extended hours. Right now, in the after hours and tomorrow morning in the pre-market, you've got lots of stocks that are moving up and down. So I want to see them. So now I've got them. I click on it, extended hours movers, Amazon, Netflix, WDC, Twilio, Team, LUMN, ILMN. All these stocks are up after hours. Net, Cloudflare reported earnings. Ticker symbol is NET, NET, up after hours. Now I want to see stocks that are down after hours and just click a button. I was tired of looking at all these different things and different earnings. Blah, 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 blah. Now it's just literally a button. Down after hours. I got Roku, ROKU. RGA, Gilead, APPF, let's see, OSPN, so on and so forth. So just clicking the button and it keeps everything organized. For me, it worked really well, and now I'm just sharing it with everybody else, anybody that can benefit from this. Again, this is something that I built to help people because it's helped me and it helps other people as well. It's called breakoutsandssetups.com. Now, when you go through all of these earnings and there's stocks breaking out, just because the stock is breaking out above resistance doesn't mean I'm buying it. If it's breaking down below support, it's just me knowing the action and simplifying it. Because again, this is about probabilities, stacking the odds of success in our favor. It's all I want to do. It's just that simple. And just because I see stocks breaking out, let's say today on Breakout the Setups, there are about 29 stocks that broke out during the day today. CHRW, big gap up, and it was a breakout above resistance. INSM, another one that broke out today and had a nice rally up. CAH, Cardinal Health, another one that broke out today. FOXA, Fox Corp, broke out today. AME broke out today. VTR broke out today. TS broke out today. SQM broke out today, but it's down after hours. Just because and there's 29 different, there's more breakouts, a lot more, but I'm not going to go through all of them. But just because the stock is breaking out doesn't mean I'm going to buy it. GSAT, Global Star, GSAT broke out today. Okay, I just want to know. Again, information is powerful when used the right way. And it saved me hours and hours and hours, and hopefully it can help others as well. So breakouts, why are they important? What does that mean when a stock breaks out? It means something has changed. If you have a stock trading between 20 and 25 for 6 months, every time it gets near 25, it goes down to 20, and then vice versa. That's called a trading range. In order for that stock to double and triple or quadruple or go up 10x, by definition, folks, it has to break out above 25. There's the only way for it to go to 50. It has to go to 26, 27, 20. That's called a breakout. So the moment it breaks out, that tells me, hey, something has changed. Buyers have overpowered sellers at that moment. Now, that could change, but for now, buyers have the upper hand. That's it. I'm not going to buy every breakout. No way. But I want to see it. It's information. It's valuable. And in 5 minutes or 15 minutes or 10 minutes or 2 minutes, I can scan it, see the breakout, see the chart, done. Go to the next one. Breakout, chart, done. So on and so forth. We'll be adding a lot more stuff in the future, but for now, I just wanted to get something quote unquote on paper. Not literally on paper, but on the screen. And this way, I can see when these stocks are breaking out. And then I can go deeper. Then I can look at the earnings, and I can look at the sales, look at the numbers, look at the value, look at whatever other metrics I want to look at. But step one is I want to know the moment it breaks out. And I want to see it before it's breaking out, hence the word setup. The stock is setting up to break out. Make sense? So anyone can tell you, oh yeah, that stock had a huge move. It's up, 100% in the last 3 months. That doesn't tell me really much of anything. It's good that it's a leader. I want to focus on it. It tells me, great. I'm not going to go buy it just because it's up a lot, but I want to follow it because it's a leading stock. Okay, great. But the moment it breaks above resistance, that's an inflection point. If I'm going to buy that stock, that's, for me, a good time to be buying it because it's changing. There's a catalyst. Something has changed. The last 6 months, in this hypothetical example, it's moving between 20 and 25. Now, in order for it to get to 50, it's got to go above 25. The second it goes above it, I want to know. And that's why breakout and setups is there. I want to see that breakout. So I can determine, hey, do I want to go deeper? Yes or no? And if I do, great. If not, that's great too. So, by the way, also with movers, new highs, new lows. All this is on the website. I want to see stocks making 52-week highs. I want to see stocks making all-time highs. Same with lows. Areas to avoid, right? I'm not buying a stock 52-week low. Other people might, but that's not for me. Great. I'm going to avoid those names. Movers, up and down, same thing. See the action. Where is the big money moving? And then look for volume. Because I'm not privy to what the big institutions do in any given day or what they're doing, but they can't hide. If a stock has average volume of 10 million shares, all of a sudden it breaks out on 50 million shares. That's not, like Gary says, Aunt Mary and Uncle Bob doing the buying. It's the big institutions plowing into it. They can't hide because it shows up in price and volume. All things being equal. Of course, they do their best, but when you see thunderous volume behind the big breakout, that's powerful. And it's meaningful, especially if it's in a leading stock. So we've got a way of breaking down and distilling all of the news, everything that's happening in the market, to bite-sized pieces so we can actually use the information. It's the action that we take determines our success. Up next, we've got a lot more to cover. I'm Adam Sarhan. I want to thank you very much for being here. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience, anytime you want, on any device. All right, so Apple, little update here, was down earlier. Now it's up slightly in the after hours. It's up about 2%. Tim Cook said that the iPhone 17 demand is quote-unquote off the chart. Very strong. He expects revenue to grow 10 to 12% on a year-over-year basis this quarter that we're in, which ends at the end of the year, at the end of December. Strong forecast. The numbers, EPS was $1.85. The estimate, again, $1.77, 175 range. It was a beat, just to be clear on the EPS standpoint. And the revenue beat as well. It came in at 102.47 versus 102.24. The main businesses for Apple, they've got iPhone revenue came in at $49.03 billion versus $50.19 billion that's expected. Mac revenue, so the iPhone revenue was a little bit lighter than expectations. Mac revenue came in at $8.73 billion versus $8.59 billion estimated, so that beat. iPad revenue came in at $6.95 billion versus $6.98, slight miss there. Other product and revenue, $9.01 billion versus $8.49 billion. That was a beat there. And then service revenue, they make a lot of money, $28.75 billion versus $28.17 billion. So he said year over year, he expects revenue growth to be 10% for the quarter that we're in now. He says we expect total company revenue to grow by 10 to 12% year over year. We expect iPhone revenue to grow double digits year over year, and we expect that we would make the December quarter the best ever in the history of the company, Cook said. Now that is powerful. So when you have the CEO come out and say all of that, that was after the actual numbers. So you see a knee-jerk sell-off initially, and then it's up afterwards. There was a one-time tax charge of $14.29 billion. So the company had $27.46 billion in net income. All right, I'm just making sense of all this as I read it with you. But stock's up now after hours. It's up about 3.5%, and it was down initially. That's a good reaction, especially when you see it shake off earlier weakness and rally. I like that. It tells me that, oh, okay, had every chance in the world to fall, and instead of falling, it's up. So that's good. All right, next. Spoke about stocks moving up and down. We spoke about some more movers. Let me give you some more movers on the downside. AJG, Arthur Gallagher's down about 8% after hours. DXCM, which is Dexcom, down same thing, about 8% after hours, or falling heavily. Areas to avoid. When you see a stock, all things being equal, down 7-8%, like what Dexcom is doing, DXCM after hours, that tells me to be very, very careful. In fact, stay away from it means something investors are selling. Something not good is awry right there. IR, Ingersoll Rand, IR is down about 6%. Roku, ROKU, down about 6%. Gilead, GILD, down 3%. Again, these are stocks that are in the after hours are down slightly as I'm speaking. That could change. Just like a few minutes ago when Apple first came out with their numbers, they were down, and now Apple's up. So by tomorrow's open, Apple could be up or down. I mean, these things, lots of times they change, and they change quickly. But for now, the big winners for today after hours, Amazon, big breakout there after hours. It's hitting a new, I believe, all-time high. Amazon AMZN, let's double check that. Monthly chart, new all-time high. It's at where are we after hours? 249.44, up about 12%. And that's the stud of the day, or the big winner after hours. 242 was the old chart high, somewhere in that range, and now you're at almost at 250. So we'll see where we open tomorrow. We'll see where we close tomorrow. Just because it's up big after hours or down big could change by tomorrow. And then if we have some more earnings tomorrow morning, I believe a few more, and then a lot more next week and the week after. We'll see where we close the market tomorrow. Tomorrow's the end of the week, right? And it's the end of the month. This was an impressive month in the market. We were lower earlier in the month. We reversed, had a very strong rally mid-month and towards the end of the month, and we had a big rally up until today. For the month, we're now up in just about all the major indices. Yeah, the S&P's up, the NASDAQ's up for the month, the Dow's up for the month. This is every month, by the way, since April. The market's been up now. The Russell 2000 small caps is up for the month. The mid cap is down slightly for the month. But otherwise, all the other indices are up. And that's powerful. That's really, really powerful. So when you have a environment where you were lower, but you end higher, all things being equal, that's bullish. Yes, we are extended in the short term. Yes, we can easily pull back. Yes, we're seeing distribution. Yes, it's a split tape under the surface, there's lots of areas to avoid that are in downtrends. Chipotle, restaurants, for example. Good example there. Just an area that's not acting well right now. Area I'm out avoiding. And when a stock gaps down on me big, especially on numbers, I usually get out. I hope I'm not involved, fingers crossed. But if I am, hey, something changed. It's the catalysts, right, folks? It's what I do with the information that matters. And I don't have to just knee-jerk sell it just because it's down on earnings. No, but it depends on where I own it, depends on where I get in. But all things being equal, I like to see stocks rally and gap up after earnings. That shows me a sign of strength. That's bullish. When stocks gap down and fall, not so much. More bearish, right? Not always. Again, you can gap down. IBM is a good example. Gap down on numbers just last week or the week before. I think it was last week. And what happened? Reversed the same day, closed lower, but the upper half of the range, IBM. And then the very next day, thunderous rally and breaks out of a nice base. And now it's way higher than where it was when it reported earnings. That's powerful, folks. That is a great example of, hey, I sold off initially, but then buyers showed up immediately. Even that day when IBM fell, it closed in the upper half of the range. It means anyone that wanted to sell sold. More buyers showed up, overpowered the sellers. And then the very next day explodes higher. On volume too, by the way. Very, very, very strong action. That's a good reversal from a reversal, right? So take your time with the market. We are a little bit on the extended side here. We've got a lot more earnings coming out. There's no quote-unquote rush. Let's see, Coinbase reported also. Coinbase is up a little bit after hours. Take your time. There's no rush. And for now, it's another day, right? And we'll see how the market acts towards support. 21-day moving average, 50-day moving average, and so on and so forth. I believe that's all the time we have for you today. Thank you so much for being here. This is the one and only Investor's Edge.